December 27th, 2025. While the world prepares for the arrival of a new year, the global silver market is currently staring down a wall. In just 4 days, China will officially implement its new government licensing requirement for all silver exports. This is not a distant policy shift. It is an operational change occurring right now. In the following minutes, I will show you why the physical market is undergoing a historic structural break. We are witnessing global prices nearly doubling, shattering significant resistance levels to climb well over $74 an ounce. Just yesterday, silver reached a documented record high of $75.14, with some spot markets pushing even higher toward $80. This represents the moment where the perception of an infinite physical supply has effectively vanished. While mainstream analysts are characterizing this as a standard period of year-end volatility, the underlying data suggests a far more permanent structural shift. It is essential to understand the mechanics of this move as the window for traditional market behavior appears to be closing. You can verify these figures yourself, but what is often overlooked is how a specific inventory drawdown in Shanghai has acted as the primary catalyst for this global price correction. This is just the beginning. To understand the present, we must analyze the factors behind this surge. Silver has experienced an approximately 158% year-to-date explosion, driven by what is best described as a fundamental supply-demand identity crisis. Industrial requirements for high-efficiency solar panels and next-generation electric vehicles are now consistently outpacing global mining and refining output. This is not a typical cyclical rally, but a total re-identification of the asset itself as a strategic industrial conductor. In major Eastern hubs, premiums have reached a significant 62% over the underlying paper price, indicating a growing divergence between digital price discovery and physical reality. Available market information paints a clear directional trend. The world's industrial base is hungry for silver, while accessible reserves are thinning. This is a matter of pattern recognition based on clear industrial data. You can see the trajectory as prices consolidate near that record $75 mark. Is this a temporary period of volatility, or are we witnessing the start of a permanent vacuum effect in the supply chain? Review the data for yourself. Phase 1. The inventory vacuum. On December 2, 2025, a critical threshold in the physical market was crossed. Data from the Shanghai Futures Exchange revealed that silver inventories had plummeted to a 10-year low. Public reports indicate that physical metal is moving into private and industrial stockpiles at a rate the broader market cannot easily absorb. Inventory levels were recorded at approximately 531,000 kilograms. While that figure may seem substantial to a retail observer, for global industrial throughput, it signals a period of extreme tightening. These reserves are not merely being traded, they are being strategically managed and held. When a primary global manufacturing hub experiences a reserve drain, the impact spreads throughout the entire technology sector. Analysts have monitored this tightening for months, even if the primary headlines remained focused elsewhere. The market was not as stable as suggested. This is a classic vacuum effect, where available ounces are pulled into the center of the industrial supply chain. Disclosures from the industry indicate a shift in how these domestic reserves are utilized. The evidence shows a systematic move toward securing the world's most essential industrial metal. Look at the numbers coming out of the East. The drain is accelerating, leaving international exchanges in a position that many experts have suggested could lead to physical delivery challenges. We are seeing the reality of a global system that has relied on paper promises, while physical availability has steadily diminished. Phase 2. The strategic export framework. The shift entered the wider consciousness just hours ago when Elon Musk highlighted the impact of China's export controls on the industrial sector via social media. This moment brought high-level attention to a quiet but massive shift in global trade. The upcoming implementation of the government licensing requirement on January 1, 2026, has fundamentally altered the tech world's procurement strategy. This policy involves strategic stockpiling and restricted movement of metal. Silver-linked funds in the region have surged over 220% this year, reflecting this internal pressure. industry disclosures now suggest that silver is being reclassified as a strategic resource. We are observing the construction of a new economic framework where metal is prioritized for domestic high-tech manufacturing. This creates a triple squeeze: accumulation at the source, licensing at the border, and potential price controls within the internal market. When a nation that manages a majority of the refining and supply chain puts up a barrier, the global market feels the impact immediately. Manufacturers in the EV and solar sectors are already seeing the tightening of these corridors. This is the new reality. The retweet from Musk was a high-profile confirmation of the industrial challenges manufacturers are currently facing on the ground. What happens to the global green energy transition when the primary source of its most efficient conductor is locked behind a strategic license? Disclosures suggest a race to secure remaining stocks has already begun. Phase 3. The domestic market shift. As we approach the final days of December 2025, the internal pressure in the Eastern markets has reached a definitive breaking point. A historic short squeeze in the region recently drove silver funds up by a staggering 220%. This move represents a significant break from historical trading patterns. It was a signal of physical evaporation within the trading system. Regulators have had to step in to manage this speculative activity and ensure the stability of their own domestic industrial markets. Public reports from late December made it clear the physical scarcity has become impossible for the exchanges to ignore. Silver premiums have reached 62%, effectively making the paper price a secondary consideration compared to physical ownership. Available disclosures suggest that participants on the ground are securing metal not for a quick trade, but for long-term industrial and wealth security. This is where global pricing and local physical reality have collided. Analysts have noted that even with regulatory attempts to cool the market, demand remains remarkably resilient. This isn't a standard trend, it is a structural evolution of the market. Verify the premiums being paid now compared to mid-2025. The pattern indicates that when the spread between paper and physical becomes this wide, the exchange mechanism is struggling to function as intended. We are observing a significant revaluation of tangible assets. On December 26, 2025, the market reached a definitive turning point. Regulatory actions were taken to stabilize the frenzy following the surge in silver-linked funds. However, the signal to the global market had already been delivered. This is about observing patterns in the global economy as they reveal a core of absolute physical scarcity. For those holding paper assets, the question of physical backing has become paramount. Reports suggest that while intervention may mask the immediate pressure, it does not solve the underlying shortage of metal. If the world's leading silver producer is restricting its exports and managing domestic markets to prevent a meltdown, the true value of accessible physical inventory must be reassessed. Industry disclosures show a shift in how physical holdings are being audited and secured. The data suggests that available silver may already be accounted for by major industrial players. This is the pivot point where the general public begins to realize the rules of metal procurement have changed. The consequences of this supply-demand imbalance are now manifesting across every major industrial sector. Demand for solar components and electric vehicle production is now consistently outpacing available production. This has led directly to the record highs of over $75. We are seeing prices undergo a massive correction as supply chain concerns evolve into a full-scale procurement crisis. This is the current reality of the market. The physical imbalance has created a situation that cannot be resolved through monetary policy or interest rate adjustments. Conductors for advanced technology cannot be manufactured from currency. The information paints a clear trend. The unallocated silver that exists on ledger sheets, but not in physical vaults, is being called to account. As manufacturers prioritize the green energy transition, the price of the metal is becoming secondary to its actual availability. We are entering a period where the primary concern is not the cost, but the ability to acquire the metal at all. Procurement strategies are moving toward direct mine-to-manufacturer contracts, bypassing traditional exchanges. This is a fundamental change in the globalized market. The scarcity is structural, not cyclical. When premiums hit 62%, the market is sending a clear signal regarding physical scarcity. This is an observation of a pattern that can no longer be ignored. This is not financial advice, but a study of current market data and pattern recognition. Public reports have made one thing clear: the window for acquiring physical assets through traditional channels is tightening. Disclosures suggest that holding the tangible asset is becoming the only way to ensure a position in this market. Industry trends show a move toward physical accumulation, even as access to those channels becomes more restricted for the average participant. Information suggests that holding the metal itself is becoming increasingly more important than holding a paper promise of that metal. Even without full data on private stockpiles, the direction is clear. You must look at the export controls, the inventory levels, and the industrial demand curves to see the pattern before the next phase of licensing begins. The timeline is established. On January 1, 2026, the new licensing requirements will permanently alter the global flow of silver. We have already seen a 158% surge this year, and the structural drivers of this rally are only intensifying. This is not happening in the future. It is the reality today. Go verify the news out of Shanghai, the new export regulations, and the rising industrial demand. The era of abundant, low-cost industrial silver appears to be over. We are transitioning into a period of strategic stockpiling and restricted access. This is the moment the world shifts from a reliance on paper contracts to the reality of physical metal. The question is no longer about the price. It is about availability. The pattern is recognized. The information is here. The time to understand these shifts is now. Available information paints a clear directional trend, and staying ahead of this curve is essential for navigating the years ahead. Do not wait for further confirmation. Industry disclosures indicate a fundamental shift is here, and we will continue to track the pattern as it unfolds. Ensure you are informed before the next market update. Pattern recognized. Finish.